Can you mute? I'm going to record. Hello, everyone. Yeah, hi, everyone. Can you hear me? Hi, can you hear me? Are you there? If you can put in the chat box whether you can hear me or not, so that we can start our session, please. Okay, I can see two participants here. Hello there. I can see number one and something in Chinese. Just please reply. Okay, so you can hear me. That's wonderful. Now, what I'm going to do, I'm going to run this revision class, and I have outlined two questions, okay? And they are from the past exam papers. So you will see how I try to help you as much as I can to answer at least one numerical type question and one essay-based type question. Now, what I will do here, if I can, uh, normally I'm allowed to share. This is the chat box. All right, so I should be able to share. But it seems like I don't have. Let me copy and paste. Can work or it may not. Okay. Where's that's very strange. Now, if you can hear me, could you please type your email address here so that I can send you the questions? Because we're going to be, you're going to be doing the cross referencing. You're going to be checking the numbers. So just put your email address in the chat box, please. Okay, I've sent you the email. You should be able to receiving the document. Now I'm going to show you what you should be receiving. Right, so this is the document. Right, so this is the document you will see. So AC2091 revision class. Okay, so the question you see here, question one is a typical exam related numerical type question based on the consolidation, and it includes notes and the requirement. It's worth 20 marks. And then you will see also an essay based type question. Okay, so please check your email because I will be referring to this document all the time. And just confirm whether you have now received this document in the chat box. Please type in the chat box if you have received the document because I'm going to start very soon. Great. Right now, very briefly before I start, let me give you an introduction. So, right, so my name is Tahir. Okay, I'm an assistant professor here at SOS University of London, and I also teach various accounting courses at LSE, London School of Economics. And I have been in academia over the last 10 years, but I have not always been an academic. As before I joined academia, I worked for two investment firms for 10 years, and then I changed my career. So the firms I worked for called Bank of America Merrill Lynch is an investment bank. Okay, I was involved in the equity and economics research. Okay, um, valuing a company based on the financial models like using DCF, discounted cash flow model, advising clients purely based on fundamental analysis, which shares to buy, which shares to sell, and which shares to hold. And they were mainly institutional investors as well as high net worth individuals as well. So when I changed my career, I had to do several other qualifications. To cut the long story short, so I ended up having 3 master's degrees, a PhD in accounting and finance, and I'm also qualified chartered management accountant. So that's enough of me. I'm sure you have already seen the exam format, but I'm going to very briefly remind you that you are required to answer 5 out of 8 questions, 4 from section A and 1 from section B. All questions carry equal mark. This final exam is 80% of the overall grade. Now I'm assuming that you have already completed the MCQ element because the deadline was set in August. Okay. So if you're sitting exam in October and the exam is scheduled on the 22nd of October, 2025. Now, what I am going to do, as I said earlier, in this revision class, I will take you through one numerical question from section A, and then I will briefly discuss a non-numerical example from section B. And this will hopefully give you a proper understanding of what we are expecting from you in the exam. Now, as you have received the document, so before we start, I suggest you should read the revision class question and take notes if necessary. So let's say spend 5 minutes. Okay, it's important, especially read the notes to the question one. So these notes will be very important when I will start working on that. So familiarize yourself, spend 5 minutes. Your time starts now. Okay, any question on the question one or two? You can type in the chat box if you like. So shall we start? Just type in the chat box if you're ready. Are you there? Can you hear me? Okay, so let's make a start. Okay, now can you just tell me whether you are able to see this spreadsheet, Excel sheet, because you will see all my workings. Just say yes or no. Yes, you are the only participant. I think there were two, and then the other one for some reason, but doesn't matter because it will be recorded. So you will have access to all the participants will have access to this recording. Just tell me whether you can see this spreadsheet, Excel sheet, blank. Good. Right. So before we start, just very briefly, I'm going to talk you through very briefly how do we prepare consolidated income statement and what are the basic rules really before we start applying. Okay, I'm not going to go into too much deep detail. I assume that you have already learned all the theory aspects, okay, of this topic. So as I said, I won't discuss in detail because we have only limited time for the session. Very briefly, according to IFRS 10 International Financial Reporting Standard, okay, 10, a parent company is one that controls another company, subsidiary. The shareholding of a parent in a subsidiary must exceed 50%. And this is termed a dominant influence. Okay, so we have to look through and do the adjustment line by line. In other words, a parent has got the controlling interest in the subsidiary, and we have to consolidate subsidiaries accounts with the parent's company's financial statements line by line. Now, an associate company is one where a parent has a shareholding of between 20% and 50%, and this is termed significant influence. In other words, an associate company's accounts are not consolidated with the parent company line by line. Instead, the parent company typically uses the equity method of accounting to report its investments in the associated company on its financial statements. Okay, so these are basic fundamentals that you should know. I'm sure you do. Now, question one, if you have looked at carefully, so we have a parent company, we have a subsidiary parent company called Forest PLC, subsidiary Wood Limited, and an associate called Grove Limited. Why? Because based on note one, Forest PLC acquired 90% of Wood Limited. So it's more than 50%. So parent has got a dominant influence on Wood PLC, Wood Limited. And we also have an associate. Why? Because Forest PLC acquired 25% of Grove Limited. So parent has a significant influence on Grove Limited. Okay. So as a result, we have to consolidate line by line Forest and Wood, and then we will have to do some adjustment using an equity method for an associate. Okay, so we have only 4 notes to consult. So first of all, well, the requirement is 20 marks, 10 marks available for income statement, consolidated income statement for the year ended 31st of December 2023, and 10 marks are available for the consolidated statement of financial position as at 31st of December 2023. Okay, we also have to show the non-controlling interest. Okay, so I'll take you through step by step. Okay, but don't hesitate to raise your hand if you are struggling to understand anything. Okay, so just say in the chat box, raise your hand, I will see, and then I will try to answer as best as I can. So we will start with preparing the consolidated income statement first. Okay, you may want to start the statement of financial position. Okay, that's fine as well. Now, how are we going to tackle this numerical type question in the exam? Step by step, I'm going to show you. So we are preparing consolidated. You may want to take a note. consolidated income statement for the year ended 31st December 2023. Right, so what do we have to do? First of all, we need to calculate the gross profit. So for us to calculate the gross profit, we need to outline the sales revenue figure. Everything in £1,000. So make sure that you put the correct currency sign. And also, if the figures are in thousands, so show everything in thousand. You don't make a mistake here. So first of all, we will outline sales revenue figure. Sales revenue, we will adjust it based on IFRS 10. So sales revenue given, we will show in working one. So working one, okay, now I'm putting W1 so that the examiner will know where all these figures are coming from for cross-referencing. Right, so I'm going to put all the workings here. Workings one, I will work through sales revenue, how we arrive at the sales revenue consolidated figure. So what do we do? Well, first of all, we will just simply put everything in thousand here. Make sure that you do that. So we will accumulate both parent and subsidiaries. So forest, I'm gonna just abbreviate here, forest plus wood sales revenue to start with, add them together. So forest revenue, we have 9.3 million. And then we have woods revenue 7,350. Right. Now in note 4, it says that there was an intra-group transaction relating to inventory. Okay. So any intra-group transaction we must remove to avoid any overstating profit and expenses. In note 4 says in 2023, Wood Limited sells inventory which cost 550,000 to Forest PLC for 1.2 million. So this 1.2 million has to be removed, what we call this intra-group sales. Otherwise, you will be overstating profit. So intra-group sales is removed, which is given in notes 1.2 million. Okay, this will give us the consolidated figure, correct consolidated figure, 16.65 million minus 1.2 million, 15.450 million. Then I will link here so that for your reference, I'm going to share this Excel sheet at the end of this session. Okay, I will send you on your email. Right now, once you have outlined sales revenue, we will remove cost of sales. Cost of sales so that we have gross profit figure. Cost of sales, again, we will show in workings. We will make some necessary adjustments. Put working 2 here, cost of sales. Start with exactly the same process like we did earlier. Parent plus subsidiary, forest plus wood, cost of sales figure, which is given as 2.7 million of subsidiary and 3060 of the, sorry, parent and subsidiary. Parent is 2.700 and 3060 for subsidiary. 5760 is the cost of sales figure, but we know that we have to make necessary adjustments. So what are the necessary adjustments? First of all, we will look at, is there any unrealized profit sitting in the transaction in note 4? We can clearly see that 60% of the inventory remains with Forest PLC at the end of 2023, meaning 60% unrealized profit is sitting in this transaction. So we will remove that by adding into the cost of sales figure. Right, so do that first. Removing by adding. The unrealized profit is also called PAR, provision for unrealized profit. So how do we determine unrealized profit? It's fairly straightforward. We have got the revenue figure. We also have got the cost figure. Revenue figure is 1.2 million. And we have cost figure is 550. Okay, this will give you the total profit, okay, on this transaction, but we are only after unrealized profit. So unrealized profit is only 60%. So 60% would be 0.6. So 390 is the unrealized profit, must be removed by adding in the cost of sales figure. Now, the story doesn't end here. We know intra-group transaction must be removed. So intra-group sales, we will remove here. Intra-group sales, 1200 is removed. Now, final cost of sales figure as a result, I put here less so that you will remember. Right. Or you can show in brackets if you like, okay? Both are acceptable. So cost of sales 4.950 is then shown here so that we can calculate our gross profit figure. So these two figures are important to arrive at the gross profit. So gross profit is sales revenue minus your cost of sales, consolidated cost of sales. So 10.5 million is your gross profit. Okay, then we will look for expenses and the other items. So start with operating expenses. Operating expenses, just simply add parent and the subsidiaries figure. Okay, you can do directly here. So parents operating expense, we can see 1765 plus subsidiaries is 1926. So total operating expense is 3691. Right. So once we have got this one, then we will look for the next item. It's called shares of the associate profit. This will be added. Okay. Shares of the associate profit. This we will show in our working because we need to make necessary adjustments. So what adjustments? First of all, right, so in working 3, put the heading first. So we are working for shares of the associate profit. So we will start with step by step, right, I'm going to do it here in 2 columns. So put the 1000 here as well. Right, so okay, so we start with the parents share of Grove's profit before tax figure. So Forest parents share of Grove's profit before tax figure. PBT, profit before tax, and is given in the question as 569,000. Right, so what do we do next? Well, 569, no, it's not the correct number. We need to make adjustment here. The profit figure is 2274. Yeah, I did put the final number here, but you need to show how you have arrived at this number. So we will calculate that. Right, so the profit before tax figure is given 2274. 2274. 2274. And parents acquires 25%. So 25% would be 0.25. That's how you will get 569. Put the direct one. Right now, next step will be we will have to remove the impairment. So how do we calculate impairment? Now I'm using this vertical format. Okay. In the exam, you may want to use horizontal format. Okay. You can do everything in one line. You don't have to put the description. This is for your future reference, for your understanding. Okay. So you can make these workings a lot shorter. Right. So I'm going to remove impairment or goodwill impairment, if you like. So impairment is the difference between what was paid over and above the net asset value, right? So we will look for what is forest interest in G. So parent's interest in G is that how much amount was paid. And it says in note 2, when the 25% holding was acquired, the parent paid 580,000 pounds, right? So we put this 580,000 pound here. Now we will look for what is the net worth assets acquired. We know 25% is acquired of what? Total net asset value, capital and reserves are equal to net asset value, okay? So net asset or capital reserves were 1.8 million, but only 25%, 25% were acquired. So we'll put this in here. Less F interest in G. F interest in G. How much is the interest? Well, we know net asset or capital reserves value is 1,800 and only 25% was acquired. So in total, 450,000. So what is the goodwill? Now you can see goodwill is the difference between amount paid over net asset value acquired. So 130,000 is total goodwill generated on this transaction. This is your goodwill. Now we are looking for impairment. And in note 3, it says that the goodwill for all acquisition is capitalized. Impairment of 50% is to be recognized against the goodwill of Wood Limited, which is a subsidiary, and impairment of 20% is to be recognized against the goodwill of Grove, which is an associate, so which is what we are looking for. Now, goodwill impairment as a result, right, so 20% of 130,000. Take this amount, goodwill, and just take 20% of that would be 0.2. So 26,000 is the goodwill, which will then allow us to calculate the shares of the associate profit. So FPBT minus goodwill impairment, 543,000 pounds is the share of the associate profit after taking into account the goodwill impairment. Now we're going to show this in here. I'm going to link this so that you will remember. 543. We have dealt with the shares of the associate profit. Next item will be goodwill impairment. Goodwill impairment, when I say, will be relating to the subsidiary, right? So it's exactly the same process like we did. Only thing, we will not take into account the profit before tax, which is simply the amount paid versus net asset acquired, and then we take the 50% of that because of the instructions we are given. Right, so put this here, goodwill impairment, and this will be our working for. Right, so go down here, working 4 is for goodwill impairment. So how do we start? As I said earlier, pretty similar to the one we did in working 3. So we start with F forest parent in wood. Right. So amount paid, how much was paid when 90% was acquired? When 90% was acquired in note 1 says 5.2 million. Right, put this in here to start with. And then we will look for what is the F interest in W less F interest in W. Right, so how do we calculate? Now, if you have looked at carefully, we have additional information in note 1. It says at the date of acquisition, the fair value of Wood Limited's non-current assets was 13.4 million. And if you look at carefully in the balance sheet, non-current assets of Wood Limited at cost been shown 11.6 million. So there is an upward movement in the non-current asset. And we also have been very clearly told that Wood Limited has not accounted for this revaluation. So we have to take into account this as well. Now we will start with, so watch this very carefully. We will start with the reserves and capital given, capital and reserves given at 2.6 million. And there is an upward movement in non-current assets. We take into account that effect as well. So fair value is 13.4 million. And then we might remove the non-current asset at cost 11 before realizing this effect. This will give us the actual correct figure. And then we are only interested in 90%. This is what we have been told. So 3960, this is F interest in W. This will then allow us to calculate the goodwill value. You can clearly see the amount was paid is higher than the net asset value. So goodwill is generated 1.240. Now impairment, goodwill impairment, we can easily calculate once we've got the goodwill amount. Goodwill impairment we know is 50%. 50% of goodwill would be half of that. So 0.5, 620 is the goodwill amount. That will appear here. Goodwill impairment is removed. Right, so we have calculated 620 million. Right, now what do we do next? We can then easily calculate profit before tax figure by simply adding and deducting figures from gross profit. We don't need to put, beg your pardon, we do not need to put here a line here. Why this one? But we do need to put here. Right, so gross profit minus operating expenses plus your shares of the associate profit minus your goodwill impairment. 6732 is your profit before tax figure. And then we will calculate tax figure. Tax you can do directly here, but I will show in working 5. Why? Because we know parent has got the dominant influence on subsidiary, but only has got a significant influence on the associate, which means that we have to we can add tax figures of parent and subsidiary easily, but we cannot take the whole of the tax figure of the associate because, as I said, parent hasn't got the dominant influence. So tax calculation, fairly straightforward and easy calculation. So we will show forest plus subsidiary, your wood, two figures together. So look at carefully. So we have 1220 for the pattern text figure, and then we have word 614. Right, so we will do that, and then we will add F in G only the amount of text figure only purely based on the shareholding interest. Okay, so only 25%. The text figure of associate is 440, but we are only interested in 0.25. Okay, we cannot claim that. So 110 is the actual figure we will take into account. So total text figure 1834 plus 10, 1944. All right, so I'm going to show this in here. Right, so we have done this. We can then calculate easily profit after tax. So simple calculation, take the profit before tax minus tax figure 4788, profit after tax. Now, final, we have been told that we must show NCI. So NCI then is remove. Right, so we can show separate in the working, but we can do directly here. So simple process is take the subsidiaries profit before tax figure and then remove unrealized profit, and then NCI, non-controlling interest, if the parent holds 90% of the subsidiary. So what would be the non-controlling interest is the difference between 90% and the remaining 100. So 90% is the control, okay, by the parent. So only non-controlling interest is left, 10%. So start with profit before tax figure of subsidiary, which is given as profit after tax figure is given as 1750, and then remove unrealized profit, which we know have already calculated 390, and then we will take only the 10% of that. So 0.1 will give you only, why are we getting 14? No, not 10% would be 0.1. So 136 is the NCI, which we will remove from here to arrive at the final figure, which I will show you in a minute. 4652 is profit after tax and NCI. So this is worth 10 marks. Okay, this is worth 10 marks. Any question? So we have prepared the consolidated income statement after taking into account all the necessary adjustments based on IFRS 10. Any question? Just say in the chat box so that I know. If you don't, just say no. If you have, just please type the question if you want to. Are you there? Okay. I don't see you there anymore. Might be a technical problem. Okay, now I'm going to continue so that you will see how we prepare the statement of financial position or balance sheet, also known as balance sheet. Right. So I'm going to prepare here. Now, balance sheet is prepared as at because it's a snapshot at a specific date. Okay. Things will change if you were to prepare on the next day. So we are preparing on 31st of December 2023, the statement of financial position. Okay. If you were to prepare on the 1st of January 2024, the position will be different. That's why we prepare as at a specific date because it's a snapshot telling how much assets and liabilities worth. Right. So we are preparing the next statement is statement of financial position, and I'm going to take you through slowly. So first of all, put the heading consolidated statement of financial position as at 31st of December 2023. Right. Now, what does this involve? Well, it involves first part, we look for assets, okay, non-current and current assets. And the second part is liabilities and capital, share capital, okay, equity side, equity and liabilities. So we start with non-current assets. Again, everything will be in thousand, and I will also do the cross-referencing, reference here. So start with, yes, everything will be in £1,000. Put this in here first. But then we will start looking at individual items. Now, non-current assets to start with. Now, non-current assets will be fairly straightforward. Just adding two figures together. Parents, non-current assets worth 13,000, 13.24 million, 13,240. Okay, 13.24 million. Plus the subsidiaries, we have been told in note 1, the fair value of non-current assets is 13.4. Okay, don't make a mistake. Don't put at the figure at the cost, assets value at cost. Okay, 13.4 is the net fair, the fair value in note 1, non-current assets value, non-current assets 13.4. Yeah, so fair value of Woods Limited on non-current assets was 13.4. Okay. In total, you will see 26.640 consolidated figure. That's the easy and simple start. Right now, we will look for the next item is investments. Investments, we will start with the parents figure. Parents figure is given as 9.320, 9.3 million in the words. Of course, this will be adjusted. Why? Because parent has invested in the subsidiary and associate. So the cost of the investment will be removed from this 9.320 figure. So how much was invested? If you remember, when the 90% holding was acquired, parent has have invested 5.2 million. And when 25% of associate acquired, cost of that one was 580,000, 580. Right. So Adjusted figure investment is 3.540. Right, now we have done this one. Now goodwill. Goodwill. Right, we're gonna show this. Well, we can do the cross-referencing because we have already calculated goodwill figure in working for. To just simply go in working for, look at the goodwill figure. Goodwill figure, right, is 1.240, but remember has been impaired by 50%. So 50% of 1.240 will be 620. Just take this number. So goodwill is worth now 620,000 pounds. Okay, after taking into account the effect of impairment. Right now, next thing is shares in associates. This will be based on shares in associates based on our working six. So let me show you how we deal with this. So I'm going to show in here. Number 6 is for shares in associates. So where do we begin? Well, first of all, look for cost of investment by the parent. Cost of investment by parent Forest, right? In associates, how much money was invested? We know we have already learned was 580,000, right? So that's the start. What do we do next? We will look for the parent shares of associates post-acquisition profit. And there is a formula for that to calculate this figure. So we're going to add Forest's share of Grove's post-acquisition profit. Right, so how do we start? Well, there's a formula. We know how much is acquired, 25%, right? 25% of the difference between retained earning at 31st of December 2023 and retained earning at acquisition. Okay, so that's the formula. So retained earning at acquisition is not given. Don't worry, we can calculate that. But retained earning at 31st of December, if you look carefully in the balance sheet, is given as 3.70, yeah, is given in the balance sheet. So we take that into account, but before we do that, we need to calculate the retained earning at acquisition. So how do we calculate? We have got figures to work with, right? So in note 1, in note 2, we have been given capital and reserves figure, okay, total combined figure as 1.8 million. So is this the total? If we remove from this figure the share capital figure, which is sitting in the balance sheet, we will arrive at the retained earning at acquisition. So let's do this very quickly. So we have total capital reserves figure 1.8 million. Share capital sitting in the balance sheet as 1080. That this will allow us to calculate retained earning at acquisition, which is 720. So as a result, we can finally calculate 25% of retained earning at 31st December minus retained earning at acquisition. All right, so start with retained earning at 31st of December 2023 is given as 3.7 million. minus, we have already calculated retained earnings at acquisition. We are only interested at 25% would be 0.25. So 745 million, this will be added in the cost. And then final thing, we will remove the goodwill impairment, which we have already calculated. Right, so I'm going to remove goodwill impairment. So we can just simply go back to our previous working, which we, right, so working 3, here we are, 26, we calculated earlier. It allow us to calculate the accurate figure, which will be 1.325 billion minus 26,1299, and this will appear in here. So I'm going to link this. Right now, I don't see anyone here, but if you want this Excel sheet, I will be happy to share this with you. I'm going to let you know my email address later on. Okay, so feel free to drop me an email if you want this Excel sheet, a spreadsheet. Right, so we have arrived at this number. Now, what do we do next? We will look for figure inventories. Right, so inventories we can directly calculate here. Parent, we have 1620 plus subsidiaries 2916. Do we have to do anything else? Yes, we do, because we know there is unrealized profit sitting in inventory and transactions. So how much was the unrealized profit or PERP? Remove that. So actual inventory figure would be 4146. And then final figure, final item under assets will be cash. Cash is simply adding two figures together. Parent has got cash worth 2892 plus subsidiary cash is 1414. So 4306, we have completed asset section. Now I'm going to put the line here in Excel. If you don't know, the shortcut is alter equal. If you press that, you will automatically calculate the sum of these all rows. Okay, so total assets are worth 40.5 million. Put this in bold. Now I'm going to put the line here as well. So we have completed first section. The second section is the equity and liabilities. Right. So share capital to begin with. And we only, according to IFRS 10, only outline here parents share capital, only forest. So forest share capitals 3240. Right. We will then look for retained earnings. So retained earnings is, well, may look like a slightly lengthy working, but trust me, it's not. You can do in one line without showing, without putting all the description. But for your reference, for your understanding, I would outline all the key description so that when you revise, well, you will have to revise. You've got only 2 weeks left. Right now, retained earning, that will be the next figure. Now, this will be based on our working number 6 and 7. Now, working 7. Right, so I'm going to show you how we arrive at this retained earning figure. So working 7 is for retained earnings. Retained earnings. So where do we begin? Well, we start with the parent, just simply copy paste this number, and then we will work our way to calculate the subsidiaries and parents. Right, so forest, just a copy paste exercise, retained earnings coming from the balance sheet, which states as 8284. Right now, what do we do next? We will calculate subsidiaries, and then we will do the same thing for the associate.